Welcome back. Deepak, you're still seeing what you consider a soft recession ahead and impact from another potential rise in interest rates right around the corner. Plenty of reason for caution, it seems.
Indeed, the recession models, Merrill, can give you very conflicting signals. If you look at the market-based recession models, and market-based means where, inversion of the yield curve plays a big role, that'll give you higher odds of a recession. But if you look at the real economy, there isn't any recession, at least from what we can see. So I think it depends on what kind of inputs you're putting into the model to come up with the odds of a recession. For us, we think there's a 60% chance that we see a technical recession come first half of next year.
And what does that mean for consumers? How deep a recession is that really?
Right. So NBER defines a recession looking at 3 Ds, the depth, duration, and the diffusion. And for us, since I said technical, which means really a 2-quarter recession, so we don't expect it to be really deep, which means less than 2% of economic decline from the previous highs to the bottom. The depth, the duration will be 2 quarters, so really muted, and then not diffused, meaning not impacting a lot of industries, but specific to certain industries, especially the service era, because service industries have been the one that has gone up the most post-pandemic. So those are the ones that can bring down the broader market much more than, let's say, manufacturing. And manufacturing, for all practical purposes, is probably in a recession if you look countrywide.
Are you suggesting that consumers pull back from stocks, and what should a portfolio start to look like as we move closer to 24?
Yeah, so I think it depends on how you were positioned during the course of 23. So if you had good tech exposure, you were broadly, let's say, diversified and had equity exposure, you did reasonably well. S&P is up over 10%, NASDAQ is up over 25%. So you did recoup some of the losses from last year. However, the risk-reward ratio is a bit skewed at this point. What I mean by that is, you look at 3-month T-bill, for example, it's paying you 5.3%. That's a pretty decent number. You need to be really convinced on the earnings ability of equities and its profit margins to be, able to deploy more money into risky assets. And I think given the higher for longer rate regime that we're looking at, and real returns are getting more restrictive and positive, we should look at a pause on the equity allocation. So we are slightly underweight to our neutrals, and everyone is going to have a different neutral. Neutral just means what's your long-term allocation to that particular asset class.
Thanks for joining us again, Deepak.
Absolutely, my pleasure.
Get today's breaking business news as well as smart analysis every day at QZ.com.